so first chapter is all about current liabilities and contingencies. And so when we're doing journal entries, most of the journal entries, we will talk a little bit about long-term, but it only because it kind of has to do with with liabilities that start out as current, and we may be able to reclassify as long-term. But as far as the accounting that we're going to be covering this chapter, strictly with the current liabilities piece. And then we'll talk about contingencies. Does anybody remember what a contingency is? What's the word contingent mean? Yes, Jude.
It happens under certain conditions.
Happens under certain conditions. So it's kind of like, it's sort of like, if one thing happens, then we do this. If this thing happens, then we do this. If you know, so we'll talk about it. Contingent really means dependent upon, and so we'll take a look at those. I don't know if we'll have time to get through. We probably won't have time to get through all of this chapter today, but we'll get through a good chunk of it. And I did grade exams. I won't give them back until I have 2 folks got to take them yet, take the exam yet. So you did see your grade. If you have concerns and you don't want to wait till I pass those back in class, you're always welcome to come see me during office hours or whenever we can arrange a time that's convenient for you. All right, so just a quick definition. A liability is a present obligation from a past transaction. And I know it doesn't, well, it does say that. It says it's, arises from a past behavior. And it is a debt that is owed. It also has sort of a future component to it because you are going to satisfy that liability in the future with some asset. Oftentimes it's cash, right? So it's a present obligation that results from a past transaction, and it's going to require the transfer of, in the future, of assets. The short, easy way of saying that, these are debts that are owed. Right? Some characteristics of current liabilities specifically, and their separation or the distinction from long-term is very critical. We'll talk about why that is momentarily. But these are obligations that are payable within 1 year from the balance sheet date or within the firm's operating cycle, whichever is longer. We satisfy current liabilities with current assets. So our current assets consist of cash, accounts receivable, inventory. Converting accounts receivable and inventories to cash is how we pay for our current liabilities. Sometimes we rob Peter to pay Paul. You guys have heard that phrase, I'm assuming. So it's kind of like paying off a credit card with another credit card. I don't recommend that. But sometimes in business, we do create a liability to pay off another liability. It does happen. So some of the more common examples, and we record our liabilities, current liabilities at present value. And so that basically means that what we paid for it today, or what the value of the service was that we got today, or the product that we received. The exception is if we are working with notes payable and, like a short-term loan. Any short-term loan that's due within a year or less gets classified as current, but we record that at the future or the maturity value. So if we borrow $100,000, that's going to be due in 12 months. We record that at $100,000. Okay. So some common examples, everybody knows about accounts payable and notes payable, I think. Commercial paper is just a type of a note payable. We'll talk a little bit about the characteristics of that. We have income tax liabilities, which are generated every time there's payroll. Anytime there's a payroll, there are current tax liabilities. Dividends payable, you guys should know what those are. And then accrued expenses, that's more of a category. But some examples of accrued expenses would be interest, like interest expense, interest payable. Salaries expense, salaries payable, that falls into the accrued expense category as well. Prepaid insurance is an asset, right? Not an accrued expense. So be careful with terms like that. In accrued expense, we're talking about the liability side, not so much the asset side. Accounts payable and trade notes payable. So what is the difference between them? Well, let's see. Obligations to suppliers of merchandise or of services. That's what we refer to as, that's a general term that we usually use to describe accounts payable, right? Some key considerations are determining their existence and then recording them in the appropriate accounting period. So accounts payable, some characteristics of accounts payable. Payable on open account. That simply means an open account means that you typically have some kind of a credit limit that's been issued to you, and you can charge up to a certain amount on that account as long as you stay in good standing with your payments. Typically, we say 30 days, right? Just like we extend 30 days to our customers to make payment to us, our suppliers and our vendors extend the same courtesy to us, typically giving us 30 days. It can be 30 days, 45 days, 60 days. We just tend to use 30 days as in most of our examples. The instrument, the credit instrument that sort of is representative of the accounts payable is an invoice. So when you get an invoice in the mail, that's how I know that that's accounts payable. All right, so as a business, if I am paying for services from other businesses or I'm buying supplies from my vendor and I get an invoice in the mail, that's how I know this is accounts payable. I got to pay something in the future. And that's kind of how I always try to tell students to remember. Accounts receivable, you expect to receive a payment in the future, therefore it's an asset. Accounts payable, you expect to have to pay something in the future, and therefore it's a liability. Short duration, like I said, usually 30 days, right? Non-interest bearing, what does that mean? Okay, what were you going to say, Tyler? Yeah, so if you receive an invoice for $20,000, right? As long as you pay within the 30 days, you're going to pay $20,000, the face amount of the invoice. If it's late, right? We don't typically charge interest, but there's a finance charge, right? Which there is a distinction between finance charges and interest. Finance charge is typically it is an interest amount, but the reason that you're being charged that is because your payment's late, right? Interest payments represent the cost of borrowing funds, and so there is a slight difference between the two. But we typically don't have interest on accounts payable. If we do, what do we call those instead of accounts payable if there's interest associated with the transaction? Well, well, it's not accounts payable anymore. It's what? If there's usually if there's interest, we actually treating it like a loan. So it's more like a notes payable if there's interest than accounts payable. Accounts payable is just a courtesy. An extension of credit, it's a courtesy, giving people 30-day grace period, right, to make a payment. It's not you're loaning anybody money, okay? It's just an extension of a grace period. Trade notes payable, slight difference here. A trade notes payable, there's the word notes payable. We don't typically, at least when I teach this, in Accounting 101 even, I don't typically use the word trade in front of the notes payable, but I try to make sure everybody understands that the word note means loan. That is an old-time term. If you still have grandparents, and your grandparents might not even be old enough, great-grandparents maybe, back in the old days they would say, I have to go pay my bank note. And that meant that they had a loan at the bank that they had to go and pay. And they called it a note because that's literally what it said on the actual piece of paper that represented the transaction between them and the bank. Remember, everything was on paper at one time, right? Before digital. So when you had to make payments, you had to either, you drove to the bank, put things in the mail, that type of a thing. Typically a longer duration than 30 days, and they do bear interest, right? Any questions on some of the basic characteristics there? All right, so some examples of short-term notes payable. And then I'm going to actually head right into the brief exercises, and we're going to work on a couple activities there. So some characteristics, and you can see there are different classifications or categories of short-term notes payable. Basically, this indicates some kind of temporary financing with a bank or some other financial institution. A promissory note is signed. What's a promissory note?
Isn't it just like a thing you sign that says that you'll pay it back?
Yeah, it is a legal document, actually. So if you borrowed money to come to school, if you have a student loan, you signed a promissory note saying that you promised to pay back your student loan beginning 6 months after graduation at a certain amount of interest. And most of us kind of, those are all digital forms now for the most part. We just click where it says, initial here, sign here, and we just, kind of want to get it done and over with. But what you have to understand is that you're literally signing a legal document that says, I promise to pay this, and there are consequences if you do not pay it, such as wage garnishment. What does that mean? Oh yeah, they take money out of your paycheck. We don't like that. We already have enough taken out of our paychecks, right? Lower interest than long-term debt, yes, typically, because if you think about the cost of borrowing, somebody is giving you their money to use, right? And so the longer you want the use of their funds, right, the higher the interest rate's going to be. So the opposite would be true. The lower the interest rate, right, or the shorter the term, the lower the interest rate, right? And then companies, they do have flexibility. It's kind of like, you don't put all your eggs in one basket when we're talking about investments. The same is true when you're trying to finance your operations. Commercial paper, we'll talk more about. We've got unsecured versus secured loans. That has to do with collateral. And then credit lines are basically pre-arrangements to borrow funds from a bank or financial institution without having to kind of fill out paperwork all the time. I don't know what's going on in that back right corner, but if you guys are on your laptops doing something else other than paying attention to this, stop it, because you're pissing me off. So all I keep seeing smirking and smiling and looking around between the three of you back there. I want you to stop it right now. I'm telling you right now, I don't want to see it either, or move. You guys can come up front if you want, but whatever's going on back there needs to stop. All right, so what's a credit line? A credit line, like I said, is like a pre-arrangement. So you approach a bank or a financial institution and you set up an amount of money that you want to borrow against at any given time. So individuals can do this too. We call them lines of credit, kind of the same idea. And a line of credit is a set amount of money that's sitting there you can borrow against. So let's say that you have a line of credit of $75,000. And something happens in your house, maybe you have like maybe your heat goes out or something like that, you need a new furnace, and it's gonna cost you 10 grand. Well, you can, if you don't have 10 grand sitting around to pay for a new furnace, you can write checks. It's like they kind of give you a checkbook and everything. You write a check to pay for this. It comes out of that $75,000 line of credit, and then the bank will start sending you like a statement each month, so you pay down the $10,000, you pay it off. You can borrow up to $75,000. So if something were to happen a couple months later that you don't have the cash for, you can write another check out of this line of credit. It's actually a really nice way of kind of having like a little safety net. Now people do, the most common for like individuals is a home equity line of credit. And so that's based on the amount of equity you already have in your house. So for example, if you bought a house and paid $200,000 for it, you put $50,000 down, you owe $150,000, right? So maybe your line of credit is that $50,000 that you already have paid into your home. It wouldn't be all 50, but it's probably 80% of the 50. So we'll say 40,000. But that might be how much the bank is willing to loan you, okay? So you have committed versus non-committed. And a committed is exactly what it sounds like. It's just a more formal arrangement. You have a fee that you have to pay to a bank to keep that credit line available. You have an informal arrangement, which is basically you don't have to go through all kinds of formal loan paperwork. And it's kind of nice. It depends on the bank and the type of arrangement you're looking for there. But that's what we refer to as credit lines. Businesses use these as well. So I used to work for an insurance agency, and we had a credit line. It was like $1 million. And at the end of the year, we always had to borrow against it because there was a timing issue between when our big revenue stream came in and when we had to pay out a lot of bills. So that was like December, January. So we would borrow against this line of credit at the end of December to pay our bills. And then in January, we would pay it back after our revenue stream came in. So it kind of was like a little cushion to kind of help us to get through, like the down period. And so when you have businesses that are cyclical, like, like around here, it's easy to kind of come up with those, swimming pools, ski resorts, right? There are going to be times throughout the year where they may struggle to pay bills. So lines of credit are always helpful during those times. Just quick review on the interest calculation. At this point, you guys should know this, right? I mean, we've done this a lot. So Interest is equal to the face amount, also known as the principal, right, or the maturity value. There's several different terms I could, exchange in there, times the annual rate. That is key. The interest rates that typically we're presented with represent an annual fee of borrowing. So if you are presented with an interest rate of 12%, right, that's how much it costs you if you want to borrow the money for the entire 12 months, right? The third piece of this, the time to maturity, is a prorated amount, right? So if I'm only borrowing the money for 6 months, I don't want to pay 12 months worth of interest. So that second half of this calculation is really, it's a proration of this annual rate if you're borrowing the money for less than a year, right? So this goes with this, basically. And if you're borrowing the money for a full year, then it's 12 out of 12 is your time to maturity, so there really is no proration in that case. But we'll see examples of that as we go through this. Questions so far? All right, so here's an example. On May 1st, Affiliated Technologies, a consumer electronics firm, borrowed $700,000 cash from First Bank Corp under a non-committed short-term line of credit arrangement. So why would a bank be willing to have some kind of arrangement with, let's say, Affiliated Technologies, obviously? Why do you think a non-committed is okay? What do you think exists already for this bank to be like, yes, it doesn't need to be formal? Yes, ma'am. Yeah, there obviously is some kind of relationship or connection there, right? That they've established previously. They're not going to give everybody some kind of non-committed short-term line of credit. So obviously there's some history there. So they did this by issuing a 6-month, 12% promissory note. Interest was payable at maturity. So on May 1st, the consumer electronics firm borrowed cash. So you have to ask yourself, now again, we're focusing on the liability side. So we are recording liabilities here. We're not the bank. We're not doing the journal entries for the bank. We're doing the journal entries for the borrower. So a debit to cash for $700,000, a credit to notes payable for $700,000. And you know me, I'm going to use T accounts when we do our own transactions up here together. So get in the habit. 6 months later, you pay back the principal, which is the $700,000, plus the interest that has accrued. What has to happen in order for interest to accrue? And I don't know, maybe I'm not asking that in the easiest way for you to answer it, but what has to have happened? Yes, ma'am. Yeah, exactly. Time has to pass. So on May 1st, there's no interest due because no time has passed, right? Interest represents the fee that the bank is going to charge you for the time you are given to use their money. And the arrangements say you don't actually have to pay back the interest till you actually pay off the whole loan. That doesn't mean that interest doesn't accrue at the end of May, at the end of June, right? At the end of July, at the end of August, at the end of September. It just means that you don't have to pay it until November 1st, okay? So on November 1st, the interest expense calculation, and there's the formula. We've got principal of $700,000 times an annual rate of 12% times 6 divided by 12, right? 42,000. And so that's 6 months worth of interest. And then the debit to the notes payable, because that clears it out. And then when you write that check, think about loans that you take out too. When you have a car loan, principal and interest, that's what you're paying back, right? It would be nice if we didn't have to pay interest, but I doubt that anybody's going to just loan us money for free. All right, any questions there? Okay, so I'm going to show you that one. That one's pretty straightforward, but we're going to look at something called non-interest bearing notes. These are not tricky, but they can be, especially if you don't understand what they represent. But a non-interest bearing note is one, and you would think if it's non-interest bearing, it doesn't bear interest. Well, that's kind of how it is. It's just a note or a loan where the financial institution keeps the interest payment on day one. So you actually don't get to take home $700,000 if you're borrowing cash, okay? You take less than that because they keep the interest amount out at the beginning. So rather than you paying it back at the end, they keep it from your amount that you're borrowing. Now, in this particular example, they're not borrowing money. They're using a loan to buy inventory, okay? Which can happen. I mean, this is a big amount of inventory inventory. Perhaps they don't have the cash to buy all the inventory at one time. And why aren't they using accounts payable here? Because we're used to this journal entry in Accounting 101. We debit inventory or merchandise inventory and we credit accounts payable. But why not accounts payable here? Because accounts payable is typically how many days? 30. And this is 6 months. Right, yeah, so that's a little too long for an accounts payable, right? And even though it says non-interest bearing, there is interest that is associated with this. And I'll talk about that here in a minute. So it says on May 1st, Affiliated Technologies bought inventory worth $658,000 by issuing a $700,000 non-interest bearing note due in 6 months. So the inventory cost them $658,000, debit inventory for $658,000. They got to pay back $700,000. So, you know, in our original, when we learned about inventory, these obviously the debit and credit were the same amount, right? But here we have an amount of inventory that's less than what we have to pay back. That discount on notes payable, and we had discount on bonds, you guys remember that? Hopefully? No? Yes? This will become interest expense as time passes. But we can't call it interest expense just yet because what hasn't happened yet? Time hasn't passed yet, right? So it's a temporary account, right? That with each, and in this case, again, you're not required to pay back the note for 6 months, so you don't have to do a journal entry every single month. At the end of the 6 months, we move the money from discount on notes payable, we clear it out, and we call it interest expense now because time has passed and that makes sense, right? We've accrued our interest. So when you go to pay it back, you remove the discount, debit interest expense, and then you pay back the note. So debit to notes payable and credit to cash. So the problem with these interest-bearing notes is that the effective rate of interest, the interest rate that is maybe stated in the note, is not the same as the effective rate. Because you think about it, you're paying back an amount that's higher than what you're borrowing or what you're getting to use, correct? So in the next slide, you can see we calculate the amount of actual interest that this is. So sometimes interest in such arrangements is described by referring to a discount rate that is applied to the face amount of the note. So what the bank would have said is we're discounting the note, hence the word discount on notes payable. We're discounting the note at 12%. So a lot of consumers think, oh, I'm paying 12% interest, but you're really not, right? So if we kind of go through this, the amount borrowed under this arrangement is only $658,000, okay? But the interest is calculated as the discount rate of 12% times 700,000 times the fraction of the year that the note's outstanding, which is the 6/12. So this is 42,000. This is the same example the previous slide. So if you take that 42,000 of interest, right, for 6 months, and you divide it by the amount borrowed, you get 6.38% for 6 months. If you want to annualize that rate, you multiply it by 2 because, right, 6 out of 12 twice a year. That gives you a rate, and I just doubled it, but 12 over 6 multiplied by 6 is 2, right? So actually 12.7% is the effective rate of interest. Banks and financial institutions got in trouble for not being transparent about these rates when consumers would go to get these loans. This is, I mean, there are laws to protect consumers, and banks have to reveal this effective rate, but still most people don't understand what that means. So if you are, looking at an arrangement of a 12% discounted note, just understand you're actually paying a higher rate of interest because you're paying back more than what you're borrowing in this case, from the face amount of what you're borrowing. So you have to be careful there. And again, like there are laws to protect folks that, banks are supposed to tell you what the effective rate is, but most people don't understand the difference between the effective rate and the stated rate, which is 12% in this case. All right, so this is a good time to pause and take a look at a couple of brief exercises so we know we're comfortable with all these loan transactions. Yes, May? Yeah, so that's why you can't call it interest expense yet, right? So still, the difference between the 700 and the 658, I still have to pay back the 700, but I only received 658 to use for myself. You see? So they keep the interest right off the top.
I mean, non-interest-bearing note, if it's late, is it a fee, or you still gotta pay more interest?
It depends. I think it depends on the arrangement. I mean, I would say it could work both ways depending on the bank, and I think they probably, depending on the customer, whatever the relationship is with the customer, I think that the answer to that could be both. Yeah. I mean, I don't think there's a single answer. There's not one single answer for that question, but, and then there are other things too that banks will do. If it's non-secured, it's just kind of just like, your good faith sort of a thing. If it's secure, there'll be collateral that's kind of put up. Some banks will require, and we'll get into this a little later, like for you to maintain a certain deposit with them to cover a payment in case you don't make one. So there are a whole bunch of different factors that could kind of play into that. All right, so we're going to look at all three of these right now. All right. So brief exercise 13.1. Get your calculators out, right? Unless you want to do mental math, I don't have a problem with that. Okay, on October 1st, Peter Fabrication borrowed $60 million and issued a 9-month, 12% promissory note. Interest was payable at maturity. All right, so prepare the journal entry for the issuance of the note and the appropriate adjusting entry for the note at December 31st, the end of the reporting period. All right, so I'm going to take it a step further, and we're going to actually do the repayment of the note too. And this is a brief exercise. I know they're supposed to be brief, but I feel like why leave us hanging? We need to see the whole entire transaction to understand what's going on, right? All right, so October 1st, the issuance of the note. And I think, personally, I know that language can be a little confusing. It's like, who's issuing the note? Well, theoretically, if I'm signing the note, I'm issuing it. I know it sounds like, well, it's the bank's paperwork, but I think that sometimes can confuse students. Anyway, so they borrowed $60 million and signed a note saying they promised to pay it back. So what's my initial journal entry? What are they receiving? Cash. And a lot of it, right? Yeah, I'm gonna skip the zeros. And what's the credit to? Notes payable. Yep. And I don't like to miss an opportunity to make sure that we know our debit and credit rules. Anytime you see this entire chapter, this is the nice thing about this, it's all about liabilities. So all of our liabilities have a normal balance of a credit, right? Yes, they do. Okay. All right, so 9 months from October 1st is what date? Yeah, and you can either do July 1st or June 30. It doesn't matter. I don't want to get hung up on that. It can be June 30 or July 1. We'll go with July 1 since that's kind of how you're counting from day 1. All right, so what happens in between though, October 1st and July 1? What date, right? At the end of the year, right? The end of the year is the end of the reporting period. And what happens on December 31st in general? Yeah, well, so this is the end of our year. We do adjusting entries. We prepare financial statements. We close the accounting period, right? So at this point, even though we haven't had to pay back the note yet, we don't pay back the note till, I'll put that over here, July 1. We have years or, okay, so we'll just say this is October, this is 2026, right? We don't have to pay this back till July 1 of 2027. That doesn't mean that I did not accrue interest 31st to December 31st, because what happened? Time passed, right? And in order for my accounting records to be correct, I need to record an adjusting entry for accrued interest, which is very simply a debit to interest expense and a credit to interest payable. This demonstrates that I have incurred some interest. How many months? 3. Yeah, so be careful. This is a very common mistake. You go December, October, that's 2 months, but you got to look at the date. October 1st to December 31st is a full 3 months, right? All of October, all of November, all of December. Okay. This gets the interest accrued for those 3 months in 2026 and establishes that it's not getting paid until 2027. Does that make sense? Okay. So now I need my interest calculation. So I've got principal, and you can do this a couple of different ways. So I'm going to do it first this way, and then talk about what else we can do. What's the rate? 12%. This is a nice rate. Why is this a nice rate? It keeps things nice and even, doesn't it? Because it essentially breaks down to what percent per month? 1% per month, yeah. And how many months of interest am I accruing? 3 over 12. All right, so what do we got? 1.8 million. Okay. All right, so 1.8 million. Now, if I was keeping T accounts of all these things, the more important piece to this is the credit to interest payable, but we'll do it this way. All right, and I'm ignoring, I don't need a T account for cash because that's really not what we're focusing on here. All right, so December 31st comes and goes. Which of the accounts that I've listed up here gets closed out? The expense account. Interest expense gets closed. What does that even mean? When I close something out, what do I do to it? I zero it out. So this would have this gets closed to retained earnings on 12/31, right? So this account essentially is zero at the beginning of the next year, right? But this balance carries forward, this payable, as does this balance, right? And now we come to July 1st, and another 6 months have passed. Do you agree? Okay. So, which is why I said, theoretically, you could do June 30 or July 1. They're literally the same day in terms of the calculation for interest. It doesn't really matter. Okay. So now on July 1st, what are we doing? Well, we're paying back the note. So we want to clear that out. We'll debit notes payable. I know the book does not ask for this, but I feel like it's a big missing piece if we don't do it. We're going to also pay back or pay out the interest payable that we previously recorded. So 60 million for the notes payable, 1.8 million for the interest payable. What about the other 6 months of interest? What account am I going to debit for that 6 months? The 6 months in 2027. Interest expense, yes. So interest expense, and I'll do the calculation right underneath here. And then the credit is to cash for all of it, right, after we figure that out. So now my interest expense, again, the interest calculation is the same, the formula. 60 million times 12% times what? 6 over 12. So how much interest is that? 3.6 million. Right? And then we add all that up, and what do we get here? Right? Okay. All those dollar signs. So, why 6 months of interest expense here? Because December 31st, we did one entry already. We did one interest calculation already for 3 months. The other 6 months of interest belongs in what year? Belongs in 2027, right? The payable, this is the total interest on the whole thing, isn't it? All right, so here's another way you can look at this. If I do 60 million times 12% times the duration of the note, which is what? It's 9 out of 12. What do I get? get $5.4 million in total interest. You agree? Okay, so the $5.4 million in interest, though some of this interest was accrued in 2026 and some of it was accrued in 2027, right? Be careful here, right? How do I break this down if I want to break it down? If I want to do it this way. My question is, what do I multiply this by to get 1.8? Sometimes I hesitate to do this because I don't want to confuse people, but at the same time, this is an option if this makes more sense to you. This is interest for how many months? Yeah, 3 of those 9 months. Oh, I'm making a huge mess. Hold on here. No, I think that goes the other way. Let me do this a little better. So we're going to multiply this by 3 over 9, right, for 2026. That should give you 1.8, right? And then here, we'll multiply this by 6 over 9 for 2027, right? So you can find the total amount of interest for the 9 months and then prorate the 9 months. 3 months of those 9 months belong in 2026, 6 of those 9 months belong in 2027. I don't care which way you do it, just be careful. This is, it's after you figured out the total 9 months of interest, then you divide by a fraction of 9. Over here, you're still dividing by 12. So sometimes I hesitate to show you those 2 options, but some students like this approach better. I don't care which way you do it, just make sure you get the right amount of interest, right? The total amount of interest has to add up to 5.4. It's just some of it was accrued in 1 year and the other 6 months accrued in the next year. All right, does that make sense to everybody? Sure? Any questions before we move on? Okay, brief exercise number 2 then. I took the entire board for that. Oh, and by the way, let me do this, because that was the whole point, right? So this was 2026 interest, this was 2027, they are different, right? And this zeroes this out. Okay. That's my time doing all that and then not finishing it. All right, so brief exercise 2. October 1st, Dutta Inc. borrowed $60 million and issued a 9-month note. Interest was discounted at a rate of 12%. Prepare the journal entry for the issuance of the note and the appropriate adjusting entry at December 31st. So really it's just a modification of this first one that we did, but a little bit of a different financing arrangement with the bank, that's all. Instead of them giving us all 60 million, we're going to get less at the onset. Why is that the case? Because this is a discounted note. And banks used to be accused of doing this because they made more money this way. The interest rate's a little bit higher. And so that's kind of where the problem came, with those kind of consumer groups that said, you're ripping people off kind of a thing. But yeah, anyway. All right, so kind of the same deal here. The discount is calculated the exact same way that we calculated it in 3.1. We take 60 million times 12% times 9 over 12. And what do we get? You guys do the math for me? What's the amount of interest, total amount? I just had it written over there. It's 5.4, right? Okay. So the discount is 5.4 million. Why am I calling it a discount? I can't call it interest expense on day 1. No time has passed. So this is very simply, this is the 60 million times 12% times 9 over 12. All right? How much do I have to pay back at the end of this? Yep. So the question is, what's the difference here? How much cash am I getting? So this is still 60 million. The discount on notes payable will eventually become, what did I tell you it will eventually become? It'll eventually become interest expense. Okay, so what's the difference there? Yeah, 54 54.6, just some basic math, right? Okay. So you only get deposited in your bank account 54.6 million, but you got to pay back 60 million. All right, so that's a discounted note. What do we, just asks for the journal entry at December 31st.
But I think it'd be fun to do the rest of it, maybe not. I don't know, what do you think?
Okay, so this was, again, October 1, right? And now we're at December 31st. So we're not paying anything back, correct? It's the same date, so we don't make a payment until when? July 1st, June 30, July 1st, right? So this is another just a interest expense, right? So I'm moving a portion of the discount into the interest expense account. And so it's the same amount as it was in the previous problem. So 3 months worth of interest is how much? 1.8. So we'll debit interest expense. What am I crediting? I'm crediting discount on notes payable, not interest payable. I already paid the interest, right? They kept it at the beginning of the loan. So it's already been paid. Okay, it's already been paid. So that puts 1.8 million here in 2026. It removes the 1.8 from the discount and leaves me with what? Leaves me with 3.6 million to eventually move into the interest expense account in 2027, right? Because what happens to this interest? It'll get closed out, it'll get zeroed out, right? So that would be 2026. So now we come to July 1, 2027. And this will be 2 separate entries. I mean, you can make it one, but I'll do 2. So what's the easiest entry? What am I paying back? I'm paying back the notes payable. So I debit notes payable. And I credit cash for 60 million. So there goes the note, paid off. Okay. This interest would have got closed out. It gets reported in 2026, right? The other half of this journal entry is me removing or transferring the remainder of the discount on notes payable account into the interest expense account. Again, the interest has already been paid, so we have no interest payable transactions here. Now I have a debit to interest expense and a credit to discount on notes payable for 3.6. And so 3.6 million interest gets reported in 2027, and the discount account gets zeroed out because I eventually have reported all of my accrued interest. Time has, that 9 months has passed in its entirety. Okay, any questions? All right, and just one more brief exercise before we move on, because I want to make sure you guys got this accrued interest down. Brief exercise 3.3. I'm going to give you a couple minutes here. On July 1st, Orcus Lab issued $100,000 12% 8-month note. Interest is payable at maturity. What is the amount of interest expense that should be recorded in a year-end adjusting entry if the fiscal year for Orcus, 2 different situations here. What's the accrued interest if the fiscal year ends December 31st? And then what would be the accrued interest if the fiscal year actually ended September 30? So you're basing those calculations on a borrowing date of July 1. But in Part A, the fiscal year ends December 31st. In Part B, it ends September 30. It doesn't ask for journal entry, it just asks for a calculation of accrued interest. So you're just applying the interest calculation that we just talked about. So go ahead, see what you come up with there, and then we'll move on. All you gotta do is use the formula. Principal times rate times time. So PRT, principal is 100,000, the rate is, and in the first scenario, how many months pass from July 1 to December 31? So July 1, all of July, right? All of August, all of September, all of October, all of November, all of December. Be careful. If you literally have to think about that and count it in your head, do it. What do you get? You get 6,000, okay. So I didn't ask for the journal entry, but this is very simply a debit to interest expense and a credit to interest payable on December 31st. You know, if you want some practice, you could probably do all the journal entries with each of these. Wouldn't that be fun? All right, so this is all it's asking for, though. That's all I'm going to ask you to do. So if we have a little bit of a different year-end date, which is September 30, July 1 to September 30 is how many months? 3 months. Yeah. So again, just paying attention to the differences in the year-end dates and making sure that you pay attention to the date on which the interest or the loan was borrowed and the repayment. Any questions? Okay, so I kind of skipped a little bit around with the slides, and I'll tell you what I mean by that in a second, just because I think it was appropriate to just continue talking about accrued interest here. I left a couple slides in here. These are just some other types of loans, like other types of arrangements. The journal entries would be the same for these. So so we talk about secured loans where you're pledging some kind of collateral, which I know we've talked about, which basically just means that if I don't have the cash to pay back my debts, then I may be forced to liquidate some particular assets and use the proceeds from that liquidation to pay my loan, right? Like a mortgage is an automatically secured loan. Why? What's the collateral on your mortgage? Your house. Yeah. If you don't, I don't know if you've known anyone that's been through this or if you have any knowledge, but it takes a long time to remove somebody from their house for non-payment of a mortgage. It doesn't happen overnight. Usually banks try to work with you until, to get those payments made, but it's a very lengthy process. Anyway, like a car loan too, right? The car itself is collateral, right? The repo man may come and take it right out of your driveway if you don't make your payments, right? I like that show. Pledging accounts receivable. So there are circumstances where if you don't have some particular asset to put up as collateral, the bank will accept you pledging certain accounts receivable as collateral. So in any event, when the account receivable customer pays you, you literally use the cash from that customer to pay your debt. Factoring is actually the sale of your accounts receivable. So of course, I had a student loan in my undergrad days, and my original loan was through PNC Bank, and I started to pay back my student loan, and a couple years into my repayment, I got a notification that my loan was sold. I didn't know what that meant at the time. I probably should have, but I didn't. That just meant that PNC Bank didn't really want to deal with my piddly little loan anymore and collecting on it, so they sold my loan and probably a bunch of others to another financial institution, who then took over the payments. My payment didn't change. I just sent my check to a different address and wrote it to a different financial institution. That probably happened twice until I paid back that loan. And so why would PNC want to do that? Well, they get all their money at that time. Then they don't have to be bothered with collecting my money and having somebody, having to monitor and control those accounts. They get their money up front. Okay. That's just another arrangement. Journal entries are the same though. That's the actual assignment of receivables would be in a note. So those would be, that would be like a kind of like a different record, but the journal entries would be the same. Commercial paper is another kind of arrangement. These are very short-term loans. They are unsecured. There's no collateral. You often find them arrangements between like parent subsidiary companies, although they don't have to be. These types of loans are usually made in increments of $25,000, and the maturity is anywhere from 1 to 270 days. So if you do the math, that's about 9 months, right? 9 times 3 is 27, so 30 days, right? That's 9 months or less. And a lot of times, companies do these because it's a lot less paperwork than going to a bank for such a short-term loan. And usually the interest rates are lower too. Interest is, though, discounted, so you get your interest at the beginning of the loan. Again, same journal entries that we did for discounted notes, but again, different types of arrangements, same accounting. We talked about accrued expenses already. This is the part I said I already covered, so we talked about accrued expenses, interest, I already went through that. Okay, kind of jumping ahead a little bit here, and some of this stuff I'm just kind of skimming over. We're not going to do a whole bunch of journal entries for it, but to kind of just give you an idea, when we talk about salaries and wages, right, we're talking about current liabilities. And I did leave a couple of examples in here for us to look at, although I probably won't have you do any journal entries associated with payroll or anything like that. I just think there's actually some payroll things at the end of the chapter. But people accrue paid time off. What does that mean? They accrue sick days, vacation days, personal days. What does that mean? If you say I accrued 6 sick days or something like that, what does that mean? Yeah, well, how do I accrue them? Like, where does that accrual come from?
It goes based on the hours that you work.
Yeah, so based on the time that you worked. I'll give you a simple example. For every month that you work, you get 1 additional vacation day a year, something like that. So the more time you put in, you get more days off, right? And every company's policy is different. I'm not here to talk about individual policies. I'm just here to talk about the fact that you actually have to do a journal entry if people have accrued time off and they haven't taken it in the period in which they accrued it. So people talk about carrying forward sick days or carrying forward vacation days or just getting paid outright for those days, right? So that's kind of the accounting we're referring to here. So accrued expenses arise when employees have provided services but will be paid after the financial statement date, okay? If the conditions below are met, the employer clearly has a liability, which is a present obligation to transfer an economic benefit that will be taken in the future. So again, like I said, vacation days, sick days, 4 conditions for accrual of paid future absences. Number 1, the obligation is attributable to employee services already performed. In other words, you worked, past tense, you did the work, right? The paid absence can be taken in a later year. In other words, it doesn't have to be taken in the current year. You can carry it forward to next year. And most companies have policies like they have like a cutoff. You can take so many extra days this year, or you can only carry forward so many days. You either take them in this current year or you lose them, or you can get paid for them, right? Every policy is different. I've seen lots of variations of that, but the key is that you know, so you don't want to lose any days, right? I feel like we lose days here. I'm not 100% sure because as a faculty member, I don't technically But I've heard Dr. Fry say, because as a dean, he's a 12-month contract, where I'm only a 9-month contract, and I believe he loses his paid time off if he doesn't take it by the end of the year, if I'm not mistaken. Payment is probable, like probable meaning, yeah, you're gonna get it, right? And the amount can be reasonably estimated. Well, I hope so, because it's based off your hourly wage or your salary already, right? So not really hard to have to accrue these kinds of things. Annual bonuses also, bonuses that are tied to performance objectives, they're typically compensation expense in the period in which they are earned, even though they might not get paid until a future period. So not really anything unusual there. And that takes us on to the next category. Do you guys have any questions? Like I said, there's a little bit of a payroll blurb at the end, but I'll save that for later. All right, so this next section talks about liabilities from advanced collections. You guys have already done these. I used to use the example in Accounting 101, I still do, where let's say that I provide lawn care services and I come to your house to cut your grass and you say to me, hey, I'm gonna be on vacation next week. Can I just pay you today for you to cut my grass while I'm gone? I say, sure. So you give me $50 to cut your grass next week. But I didn't earn that money because I didn't cut your grass yet, right? So theoretically, I owe you something. You've already given me the cash for a service I haven't yet performed. That's a liability for me. So I have to perform the service in order to earn the revenue. So that's one example of a liability from advanced collections. We'll look at a couple of others. Some of these you guys are probably absolutely familiar with, like gift cards. I don't know if you've ever thought about it. When you buy a gift card, right? Let's say you buy a gift card to a restaurant. You're literally paying the restaurant for a meal that somebody hasn't eaten yet, right? So the restaurant can't call that revenue. They can't call it revenue until the person you gifted the gift card to comes to the restaurant, orders food, and presents the gift card as part of the payment. Does that make sense? Refundable deposits or deposits from customers. So when you make a deposit, right, to secure, I don't know, a service or something like that, you cannot call that revenue. You haven't done anything. A lot, and every area is different, but I know I used to, I don't have to do this now, but my old garbage service used to have to pay a deposit for like the recycle bin or something like that. And then if you moved out of the neighborhood, you could return the bin and get your money back, okay? So that's another example of a refundable deposit. If, you know, as long as you brought the bin back, you got your money back. If you didn't return the bin, then the township would keep your money and call it revenue, because it's like they sold you the bin, right? If you didn't bring it back, it was then considered sold. So we'll look at a couple examples here. We have Rancourt Chemicals sells combustible chemicals in expensive reusable containers. Customers are charged a deposit for each container delivered, because again, they're expensive, and receives a refund when the container is returned. Deposits collected on containers delivered during the year was $300,000. Deposits are forfeited, meaning what? You don't get it back. Give it up, right? If containers are not returned within 1 year, 90% of the containers were returned, because you know there's always going to be someone who doesn't actually return them, right? Deposits charged are twice the cost of containers. What does that mean? Or why do you think they charge twice the cost of the container? Yeah, so they can make a profit if you don't return yours. I mean, that's kind of smart, right? We have to have a little bit of a side gig here going on. Okay. The inventory of containers remains on the company books until the deposits are forfeited, because until I've decided, or until I miss the date where I can return it, who owns it? The company still owns it until it's been deemed forfeited, right? Until I miss that date, which I can return it. So here is a journal entry just to demonstrate when deposits are collected, you debit cash for the amount collected. It says $300,000. Notice the account, very simple, liability. Dash refundable deposit. So that's a new one for us. That's a new account for us. when containers are returned. So it says that, actually I'm going to use the T account up here. So when these containers are returned, it says that only 90% of them are returned, right? So 90% of 300,000 is 270. So what happens in this case, and again, if you go back to the original journal entry, how much cash did you get? Well, you got 300,000, right? And you created a liability because you owe somebody something unless they don't do something for you, which is return those containers. So, and actually I think I'll do cash here too. Right, so that's our first journal entry. In this entry, only 90% of people returned those containers, right? So we reduce this, and we have to pay out the cash because they returned them. So that leaves us with some cash, and we still have this credit here. Okay? It's only a liability until the customer doesn't do what? Return it. So once it's determined you've missed the date that you can return these containers, this now is no longer a liability, but it becomes, you can see it's revenue, right? So we treat it like a sale. So we have the revenue, sale of containers. No, there. We're moving it from here, right? That's the debit to the liability account. And now we're calling it a sale. And what do you notice about two of my accounts up here? Well, this is zero now, right? But what do you notice about cash and revenue? Aren't they the same amount? So it's kind of like if you would have sold them in the first place, you would have debited cash and credited revenue for 30,000, right? Notice the second journal entry, the debit to cost of goods sold and the credit to inventory of containers, because I also didn't put this up here, but you've got this inventory of these containers and you own those, right, until you actually sell them, if you sell them, right? So there were $30,000 in here, okay, well, and then we had the debit to cost of goods sold, because once they're sold, this becomes COGS, right? Half of that is 15. Now reduce this by 15 and leave us with a balance of 15. So it's just like if we would have had a regular sales transactions where we debit cash, credit sales, debit cost of goods sold, credit inventory. In the middle, though, we have, right, this here, because we required a deposit. So that's one example of refundable deposits. I don't think I have a brief exercise on that one, so we'll take a look at one more. We'll take a look at gift certificates maybe, or maybe it's magazine subscriptions come up first. I think it's gift certificates. So the other types of transactions that fall into this same exact category, advances from customers, would be gift certificates, magazine subscriptions. Like if I buy a magazine subscription, I pay for it all right up front, right? But the publisher can't call that revenue until they actually mail me the magazine. I do not know if anybody still does layaways. You guys know what a layaway is? Layaways used to be super popular when I was growing up. Anybody know what a layaway is?
Isn't it where you buy something while it's on sale, but don't pay for it until?
Well, it doesn't have to be on sale. But I feel like you kind of heard about this. You buy something, you don't take it home with you, you put it on layaway. So like you go shopping and you go to the layaway, which is like customer service, and they keep it for you and you make payments on it. And when you pay it off, then you pick it up. It used to be a real popular way of buying things. These were the days before people used what, do you think? Credit cards, yes. So a lot of times people didn't have the cash. This was common at Christmas time. So people would say, oh, I'm going to go make my Christmas layaway. So you go buy all your Christmas gifts and you put them on layaway. You make payments on the layaway. Once you make the final payment, you pick them up. Haven't you guys ever heard of like sports people go into like a store and paying off all of the layaways for Christmas for people. You guys ever heard those stories? Okay. Special order deposits. Usually if you special order something, you got to pay for it up front because it's a special order and it's made specifically to your requirements, your specifications, and so like it's going to be hard to sell to somebody else, right? And airline tickets. You pay for those in advance, don't you? You book a flight, you pay for the flight. The airline can't call it revenue until when? You take your flight. Yeah, so here's one example, and then we'll call it a day. Tomorrow Publications collects magazine subscriptions from customers at the time subscriptions are sold. Subscription revenue is recognized over the term of the subscription. Tomorrow collected $20 million in subscription sales during its first year of operations. At December 31st, the average subscription was 1/4 expired. Why do you suppose they're doing average? How many subscriptions do you think does it take to equal 20 million? Too many to do them individually, right? So they're doing an average of the number of subscriptions expired. So on the date they receive the money, it's a debit to cash for 20 million, a credit to deferred subscription revenue. Deferred means put off. You're putting off recording something as revenue until you earn it. When the product is delivered at December 31st, they estimate that 1/4 of those have been delivered, those subscriptions. So you reduce the deferred subscription revenue account. Anything deferred is a liability, just like anything unearned is a liability. And you move that fraction of that unearned portion into the revenue account. You guys have had this before. This is not a new journal entry. And then, yeah, gift cards. I'll hold off on gift cards till Thursday. You guys have any questions on anything we covered today? All right. I will see you Thursday. No homework until we'll get through the rest of this Thursday. This chapter goes pretty fast.